Okay, welcome to the Opportunity Cost of Capital Model discussion. The Opportunity Cost of Capital Model is also called the Opportunity Investment Risk Model, and for short, we call it the ROCC model, which stands for Opportunity Cost of Capital Discount Rate. Okay, this is a nice model because it gives us a very straightforward method for computing our market. Remember, we looked at our market in our simple linear risk model, and that's the R that includes our risk-free rate and increment for market or industry risk. Okay, great features of the opportunity cost of capital market model are that it works really well. It's easy to adapt to a lot of different projects in real estate and elsewhere. And also, once we extract RM from this model, that means, as we learned when we looked into our simple linear risk model, we can use our project risk-adjusted cash flows to discount, okay? And this is what basically everyone except Warren Buffett does. Okay, so if you got some promised cash flows, you give them a haircut for stupid manager risk, and then you discount with RM or ROCC. We're also going to say a little bit later, I'm jumping ahead right now, but RM is going to be equal to the opportunity cost of capital. Okay. So let's give ourselves a definition of the opportunity cost of capital. It's always going to be for one project, for one player at a time, okay? But the opportunity cost of capital for that project, for that player, is going to be the known interest rate or discount rate for a diversified set of alternative investments or projects with similar market or industry risks, okay? And we write that as R sub OCC, and as I said on the previous page, this is the same thing as RM, which lets us discount projects back, including just project risk in the cash flows, okay? So now, what are our assumptions that we need to do this? One thing you're going to see as you go on in finance is that the more complicated our models get, the more assumptions that we have to make to use those models. And a lot of these assumptions are not good, okay? So, for example, for our opportunity cost of capital model, we're assuming mildly imperfect, inefficient markets with some mildly irrational investors. Okay, this is the type of thing that Richard Thaler, who just won at the time of this recording the Nobel Prize in Economics, that he would postulate as a good way to look at the actual behavior of a lot of markets. But that said, we're assuming here no transaction costs, perfect liquidity, so we can get in and out of investments anytime. We know that's not true in many real estate projects. And our rates are largely known or calculable, let's say, calculable, good enough. I don't know if that's a word, but close enough, okay? Our market is a niche, so we'll be working within the milieu of short-term high-yield bonds, cash flow producing properties for graduate students at certain types of campuses, that type of thing. We have some imperfect information flow. So what we mean by that is it takes some time for information to be disseminated and analyzed. And we're assuming investors are risk averse, okay, and they hold diversified portfolios close to what we'd call a market portfolio. Market portfolio, for example, would be, we looked at with the simple model, Moody's analysis of all the high yield bonds that have 2 years to go until maturity. That would be a market portfolio, and that would have thousands of bonds, and it would cost a lot to build and hold that portfolio, so we don't want to actually hold that. Also, we want to do something that we think is a little better than the market portfolio, which we'll get to soon. Okay, so also our investing duration is going to be similar to our project's duration, and our project would be in our portfolio about 1/30 of the weighting. So we're assuming we're diversified with 30 projects. Okay. So that's going to be true for a lot of REITs. It's not going to be true for a lot of development companies, and certainly not going to be true for entrepreneurs. We have some mild temporary irrationalities in the market. Again, a lot of this coincides with what Richard Thaler, the just awarded Nobel Prize winning laureate, has to say about how to look at markets. Okay. All right. So given that background, how are we going to determine for a given project, for a given player, our opportunity cost of capital? Well, we do it via 3 steps. Okay. The first one is we've got to define our investment mission, okay? You've got to know what your mission in life is, or all hope is lost, okay? So, for example, our investment mission in life could be we invest in short-term securities with strong contractual guarantees. So that would be something like one-year treasuries or CDs. A different mission could be we invest in high-risk, long-term asset-backed securities. And in that case, we'd be investing in something like subprime mortgage-backed securities, okay? We could also say, for example, we invest in cash flow producing properties that are multifamily rentals for graduate students at large state schools through the mid-Atlantic states. That would be a fine investment mission as well. Okay. So once we know our mission, the second thing we do is find what's called an opportunity cost investment that's compatible with our mission. So opportunity cost investment, that double equal sign as always means defined to be a diversified portfolio of projects with similar risks in our opinion. All right. So what do we mean by a diversified portfolio? So we want to say a set of at least 30 or more projects, okay? And such that in any given time period, the returns of each project won't be identical. That's important for diversification. And the returns of one project are not completely predictable from the returns of any other project in the portfolio. Okay, if we violate these 2 things, then we're not diversified. Okay, we will get more mathematically rigorous about diversification a little later on. But if you understand these concepts, you've pretty much got it nailed for this course. Okay, so why does our opportunity cost investment have to be a whole pool of diversified investments that fit our mission? Well, this graph says it all. This is one of the coolest graphs in all of finance. What we've got here is we've got the number of projects in the portfolio, our portfolio, on the x-axis, and portfolio risk by we could measure that by, say, for example, by standard deviations of annual returns of so our risk we could measure, for example, by the standard deviation of our portfolio's annual returns. And you notice here, if we just have one project in our portfolio here, we have a very high standard deviation. This is all eggs in one basket, right? Which you never want to do. Definitely don't want to do that, except, of course, if you're an entrepreneur, you have no choice but to do that. You put all your eggs in that basket, and that's how you are able to attract investors, okay? So as we go out to about 30 projects, and I'm just going to type 30 again here, the risk that we have is moving down asymptotically to some constant, okay? And the constant we call systematic risk, and this is going to be something like macro, econ, market type risks, okay? And our unsystematic risk is going to be what? Our stupid manager risk. Okay. So we can diversify away stupid manager risk by having a bunch of different projects in our portfolio. So and let's spell that properly. Yeah, there we go. So we can diversify away that unsystematic risk. So that's why our opportunity cost investment is going to be a diversified portfolio of projects, known projects with similar market or industry risks. Okay, then we get this beautiful benefit of diversification. And I'll add one more point to this. Okay, there are basically almost no free lunches in finance, and in general in finance, if something looks too good to be true, it is. But diversification is the one thing in finance that if you take advantage of, you can get a benefit for free. Okay, so now let's go back to examples of opportunity cost investments. Okay, so for our short-term strong contract investor, okay, who wanted to invest in very short-term stuff with very strong guarantees, okay, the opportunity cost investment could be something like a portfolio of short-term CDs or money markets. Now, this could be homemade, okay, or it could be anything else that you find that's legitimate in the marketplace. And it just so happens there's an exchange-traded fund, ETF for short, in the marketplace with ticker symbol MINT. And basically what MINT does is it invests in about 200 money market accounts and CDs. That's perfect for us, okay? That's a diversified set of very short-term investments with very low risk. So being the lazy person that I am I going to construct my own opportunity cost investment portfolio? No, I'm just going to use the already created Mint ETF. All right, now let's consider our high-risk, long-term, asset-backed investor, okay? The opportunity cost investment for her is going to be a little trickier. It's going to be a portfolio of something like, for example, subprime mortgage-backed bonds, and we'll see why that's going to be a little trickier in just a second. But basically, she's going to have to construct this portfolio herself, or with the help of the mortgage-backed securities department at a big investment bank. They would gladly do that for her and charge her $200,000 a year for that, and et cetera, et cetera. Okay. All right, so third and final thing we have to do to get our opportunity cost of capital is notice that, let me put that in here, the opportunity cost of capital, a good way to define it and explain it would be that it's just the discount rate or the interest rate of our opportunity cost investment, right? And that's going to be, of course, on a weighted average basis. Okay, so what's that going to be for a short-term strong contract investor? Okay, if she constructed her own portfolio of short-term CDs and money markets to be her opportunity cost investment portfolio, it would just be the weighted average interest rate of that portfolio. But guess what? Again, here comes laziness kicking into the fore. There is that Mint ETF out there, and the forward interest rate of that Mint ETF is published every day, so we can just look that up, and that's beautiful. That's what I would do. Okay. Now, for our high-risk, long-term asset-backed investor, we've got a different situation here, and she is going to have to create her own pool, and then she's going to have to, once she's got her pool of those investments, it gets a little trickier for her. She's going to have to take the average default adjusted interest rate of the subprime mortgage-backed bond portfolio. Okay. Up here, this is really simple. Don't need default adjusted. Here we don't really need a default adjusted R because essentially there are no defaults. If a bank does default on a CD, the federal government does step in and makes the investors whole. So it's not really that there are no defaults, but there are really no implications of those things defaulting. But definitely some of these subprime mortgage-backed bond portfolios will default. So we've got to adjust the R down to account for that. And we saw in our simple risk model discussion how Moody's, for example, provides some basis for helping sort that out for various different types of fixed income asset classes. Okay, so what are some important properties of the opportunity cost of capital? Well, remember, opportunity cost of capital is the known interest rate for a diversified set of alternative investments with similar market risk to a project we are considering So because the opportunity cost of capital is known, right, it comes for our very risk-averse investor, just comes directly from the Mint ETF. It's the truth, the whole truth, and nothing but the truth that we can make investments with a return of our opportunity cost of capital return at any time by what? Our investor, our risk-averse investor could add to her opportunity cost investment position by what? By just buying more of the Mint ETF, okay? So what does that mean? The opportunity cost of capital for this project is going to be the interest rate that we forego by pursuing a new opportunity in our self-defined investment milieu. Okay, so basically, how are we going to deal with this? We're going to figure out what our investment mission is. We're going to figure out the corresponding opportunity cost investment and opportunity cost of capital, okay? And then let's say we're an investment manager and a new client comes in and they give us $100,000. We're going to go look for some projects with a discount rate greater than the opportunity cost of capital. And if we can't find them, what are we going to do with her money while we're waiting to find them? We're going to put it in the opportunity cost investment. Okay. All right. Other thing to note here is that the opportunity cost of capital is going to increase with the risk of our investment mission. We've seen this all semester, but I just want to really emphasize this. So the opportunity cost of capital for a treasury investor is going to be much less than the opportunity cost of capital for a mortgage investor, right? And we've seen that empirically several times. Okay, and third important property of the opportunity cost of capital, as I've said twice before, but just to hammer this home, is that the opportunity cost of capital is the market-based discount rate as we've defined it, okay? So this gives us a method for computing RM, which as we know includes RRF and market risk increment. Okay, so what does that mean when we discount with the opportunity cost of capital? We use project risk adjusted cash flows. Okay, so we're going to say give promised cash flows a haircut for stupid manager, or what really is project specific risk. Okay. Okay, and as I've said before, virtually everyone uses project risk-adjusted cash flows and puts everything else in the discount rate or the interest rate. Okay, so another important note on our investment mission and our opportunity cost of capital, it's certainly true that investors can have more than one mission, okay? The finance police aren't going to rush in and arrest you if you say something like 20% of our portfolio is invested in guaranteed return opportunities with strong guarantees, and the other 80% is invested in subprime mortgages or other investments with similar risk. Okay, there's no law against that, no problem. It might be the smartest way to set up a portfolio of yours or an investment vehicle that you're trying to get money for. Okay, but in this case, we need to find an opportunity cost investment for each individual mission. Okay, you can't just take an average and use that. All right. So next up, we have an example where we use the opportunity cost of capital and the IRR method for valuing our Apex apartment development project. So I think I'll leave you to look at that in the next video. And for now, I'll say sayonara.